Welcome. We're going to take a look at a couple ETFs run by well-known investors who frequently appear on financial media outlets like CNBC. I'll compare the ARKK ETF run by Cathie Wood, the JOET run by Joe Terranova from CNBC, and the S&P 500, a popular index of 500 leading publicly traded companies in the U.S. We'll take a look at how they've performed over the following time frames: the last 12 months, the lifetime of the JOET since November 2020, and the lifetime of ARKK since October 2014. FYI, the S&P has been around since 1957. I'd first like to give credit to Cathie Wood and Joe Terranova for running public ETFs where everyone can see how they perform. I'm unaware if other personalities on the popular financial channels have such measuring sticks, but these two do, and they deserve credit for it. Now here's a quick overview of each before we start the comparisons. Check out the links in the description for my sources. Here's some info about the Cathie Wood ARKK ETF taken from Yahoo Finance. I've highlighted the expense ratio, which is a fair amount more than the category average. When you invest with ARKK, you're investing in companies that Cathie Wood thinks are disruptive innovators. And here's some info about the JOET, also taken from Yahoo Finance. It has a low expense ratio, lower than average. It tracks quality big cap companies listed in the US, similar to the S&P 500. JOET frequently talks about using momentum on CNBC as one of his primary tools for deciding what to buy and sell in his ETF. And here's some info about the S&P 500 from Investopedia. It's a select group of 500 leading US companies with emphasis on market cap. It was launched in 1957 by Standard & Poor's. It's considered to be a good gauge of large US stocks and the entire market, and it's one of the most popular indices along with the Dow Jones and NASDAQ. Now let's get to the comparisons. But first, if you're enjoying this content, please consider liking and subscribing. Here's a one-year chart from January 2023 to January 2024. The pink line is ARKK. It went through much bigger swings and ended up in almost exactly the same place with the S&P 500, up about 22% for the last 12 months. The blue line is the S&P 500. It took a much less bumpy road to get to the same place as ARKK. And lastly, the purple line is the JOET. It trailed the other two by just over 9%. It has a very similar pattern to the S&P, the same bumps. Not surprisingly, given the similarity of its holdings, large cap US stocks. 1 year doesn't really mean that much in my opinion. The greatest investor in the world can have a bad year, just like the best poker player can have a run of bad luck and lose to a bunch of fools in the short run. So let's move on and compare them from the inception of the JOET, which was November 19th, 2020, a few months after the start of the pandemic just over 3 years ago. This one paints a much different picture. This was an unfortunate time for ARKK. It missed out on a large portion of its huge gains in 2020 and got all of its devastating losses in 2022. It's a good example of even 3 years not being a very accurate measure of a fund's long-term performance. ARKK lost more than 50% of its value over this time. The purple line is the JOET and is once again very similar to the S&P 500, but just over 11% worse. Not terrible, but very unremarkable. This was a good period for the S&P 500. It held up better than most things during 2022's bear market. It had nice runs in 2021 and 2023 for an overall return of 37.5%. A 3-year time frame carries more weight than 1 year, but it's still not enough time to be confident that it's a true measure. Also, the unusual time around the pandemic adds additional uncertainty. Now let's look all the way back to the beginning of ARKK, October 27, 2014, almost 10 years ago. ARKK's lifetime chart is magnificent and terrible to behold. At one point in early 2021, it was up almost 700%. The S&P just peaked recently and is up only 150% over this time frame. It makes me think of the hare and tortoise story, but this race isn't over. The S&P currently has around a 19% lead, but that could change quickly in either direction over the next year. If you think a bear market is on the horizon, avoid ARKK like the plague and consider the S&P for safety. If you're a bull, then consider hopping aboard the ARKK rabbit ride and hold on for dear life. 10 years is a pretty good measuring stick in my eyes. You should expect to be judged based on your 10-year performance. This is long enough to typically smooth out the episodes of good and bad luck. It's time to render judgment and give my opinion of these results. I personally wouldn't invest in either ARK or the JOET, but I'm not an ETF guy. I prefer to choose my own individual stocks and sell options on them. If I were to invest in an ETF, it would be something that tracks the S&P or maybe something that tracks a beat-up sector like financials or energy. As for ARK, you're getting really high volatility. Your highs will be amazing and your lows will be crushing. If I had to guess, I'd say the long-term performance will continue to zig and zag, significantly above and below the S&P. One downside, you have to pay an above-average ETF management fee, which would annoy me. But Cathie Wood is interesting and fun. As for the JOET, you have similar volatility to the S&P, with performance that appears to lag behind it. You're going to need to buy into Joe's belief in momentum. I personally don't, but at least Joe's management fee is low. I'd watch Joe a few more years and see what he does against the S&P. Maybe he'll give us a reason to consider his ETF. A brief rant. CNBC has devolved into what's going to happen next week content. Maybe it was always like this. I wish it had more bottom-up Warren Buffett-style investing content with 10-year time horizons instead of the gobs of useless macroeconomic guesswork and technical babble about chart squiggles. But that's just me. I'm probably in the minority. And one last rant. It's perplexing why so many people look to the financial media entertainers as authorities on investment when their performance over the long term is worse than the S&P. CNBC puts much more weight on presentation and ratings rather than long-term results. I can't blame them. That's how they make their money from advertisers. What's the moral of this episode? You might want to check into the track record of money managers before following their advice, investing in their funds, or using them as authorities on how to invest. And that's a wrap. If you enjoyed this content, please consider liking and subscribing. Also, let me know what you think. I really appreciate any feedback or comments. I'm not a financial advisor. This wasn't financial advice. Just an objective comparison of the Cathie Wood ARKK ETF and Joe Terranova's JOET against the S&P 500 over some logical time frames with a healthy dose of my opinions. Have a profitable day.